Okay, welcome those who are here, and I may go through this again if I see a lot of people trickle back in towards the end. But this is Wells Fargo 2024 financial calendar for employees. So we put this together for you from experience working with our clients who are also Wells Fargo employees, and you stick around to the end. You will receive a calendar for the whole year. We're going to go over just January and February, so important actionable steps to take. But you will receive that at the end of this presentation. A link will be in the chat. And our contact is also in the chat. My name is Britton Williams. I'm a financial advisor at Calamita Wealth Management. Todd Calamita, financial advisor, owner, founder, is also with us today. And so we got a couple more people adding in. So as I mentioned, stick around to the end. You will receive the financial calendar for next year. The way this is going to work is we've got some questions that we've gotten from some of you already. We will go over them. We want this to be a discussion. So every 10 minutes, I'm going to pause. And Todd and I will be talking throughout and then pause and allow you to ask questions. We already have some to go over, and there may be some of you that are on the call. So we want to hear from you. And so throughout, don't wait, just put it in the chat if you have a question specifically that we can discuss. If you want to talk about it one-on-one, by all means, our link is in the chat to set up a call. Again, a couple more people just joined us. We will be going over January and February of next year in the financial calendar that we put together, and also stick around to the end. You will get that full year gift, which is the whole calendar. All right, so let's get started.
Yeah, Britton, the only other thing I'll add here is just this will be a quarterly webinar series. So if you stay tuned, we'll be doing another one in March as well. So we're just covering the first quarter here today.
Thanks, Todd. And yeah, and then the March one is going to be a little more specific around heading into tax season. So we'll talk about that in a minute. Let's start with January. So what you need to know is the IRS has increased contribution limits that you can make toward your 401k and IRA. So for the 401k, employees can contribute up to $23,000 per year. So if you have been maxing that out, that's something to be aware of to make those changes beginning in this month. The catch-up contribution, if you're over the age of 50, that hasn't changed at $7,500, but that employee portion has gone up. For IRAs and traditional IRAs and Roth IRAs, you can contribute up to $7,000 per year, and over the age of 50, $8,000 total combined. So let's get into some specific about the Wells Fargo 401k. One of the things that everyone you get in the first couple of months of the year is a bonus. So in the beginning of February, some of you may have a bonus that makes up 50% of your income. So making a contribution to your 401k, you'll want to skip that maybe. And I know that Wells Fargo gives you a notice on this. So what we've done is provide a snapshot of what it looks like in Empower to make it very easy of how to make to change the contribution. You could stop it altogether for that time that you get that bonus. And so the way you want to do this is you log in to Empower, you go to the accounts drop-down menu, contributions, just like you're going to change the contribution percentage. The checkbox that you want to check is over here. One time only, then revert back to current rate. And you select your submission date. And the time you want to be aware of this is January, because it may take a pay cycle to, of course, take effect. And that's where this submission date is going to be important. You'll know what your bonus is going to be heading into, like the dollar amount. And then, so middle of January, you want to get this taken care of. Again, if you got any questions, we'll talk about that in a second. Put them in the chat. We'll get to them. But let's move on to the next slide. So to consider also, uh, you receive an employer match, and you also receive this, and maybe in addition to that, the Wells Fargo ESOP portion in your 401k. So at the end of the year, in other words, this is showing 12/30/22 of last year, but the end of this month, end of this year, you should receive the Wells Fargo ESOP fund, and that's going to start building up into your 401k. And so what I want to talk about here is a little bit of the risk, not giving you advice, but you may want to consider rebalancing that into the rest of your portfolio. So for example, if your 401k is in a target date fund that's in line when you're going to retire in 10 years, and you, in addition to that, you have kind of let this Wells Fargo ESOP portion part build up over the years, that's going to that's going to present a lot of risks that you may not want to take on. For example, just an example of the volatility. In the fall of 2021, the stock price was close to $60 a share. It fell into the 30s. So that's a big drop to experience, especially if a large amount in that. It's just like any other single stock exposure, even though it's inside of the 401k. And you can sell it without having to pay any taxes too. Todd, do you have anything to add here?
Yeah, just the only thing I'll add is, I mean, we've seen clients where this has gone to 25% of their portfolio. You know, they've been with Wells Fargo for a number of years, and it's really gotten to the point where they were taking on more risk than they needed to when it came to time to retire. So again, any single stock, you know, with them putting this in here, this is the decision to buy Wells Fargo. So a decision to not diversify out of this is a decision to buy Wells Fargo. So just whatever that amount is that goes in, just think about whether that's the amount of money. Let's say it's $5,000. Would you go out today and buy Wells Fargo stock? So just keep that in mind. Again, it's under, if you go to overview and then all transactions, this is where you'll see if they made that deposit for you. And it's usually on 12/30, 12/31.
Okay. Thanks, Todd. You're getting questions, queue them up in the chat. We'll get to them in a second. You can also raise your hand, and we're going to pause here after this next section. But first, let's talk about the riskiness of target date funds. So you have available to you a lot of different mutual funds. Most of them are these target date funds in the 401k. So we thought it'd be a good idea to talk about not just like what you already know about them, but also the riskiness of each. So I'm going to hand this off to Todd, and he's going to talk about this with you.
Yeah, well, just as you know, there's a lot of other options in the 401k besides these. We pulled these out because these are really the most common that we see people go into, are these target date funds. If you're not familiar with them, the theory is that the date that you see there, so 2020, for example, 2065, those are dates of when people will retire, employees will retire when they have retired. So the theory is that if the date is farther off, it'll be more risky. And one of the things they don't really show you, or it's hard to dig up in Empower, is they don't really say what that risk level is, what percentage is stock, what percentage is bonds. So starting from the top, State Street Retirement Income Fund, you could dig for this, but we kind of pulled this up for you. The stock percentage is 30%, the bond percentage is 70%. And just to give you a perspective on that, what that means in terms of volatility or risk is that the portfolio, let's say you have $100,000 in this, and at any given time, you can expect it to drop 10, 12% just based on market fluctuations that are going to inevitably happen. So we're going to call that, let's just give some personas to a few of these. Let's call that Carol Conservative. So this is what she feels comfortable with. If we go down to the other end of it, 2065, let's call this person Larry, long-term investor. So as you can see, this is 90% stocks, 10% bonds. So Larry is willing to sustain some volatility in his portfolio for potentially better long-term returns. So in this case, $100,000, oops, okay, yeah, 100, if you had $100,000, be prepared at any point for that to drop 30, 40% in a bear market or a really downturn, a recession. And then go to kind of Maggie, middle of the road at 2035, 70-30, so 70% stocks, 30% bonds. Again, she's willing to take on risk, maybe not as much as Larry. So her $100,000 portfolio at any given time, be prepared for it to drop to 20, 25% in a really bad market. So just want to give you some perspective on what that really means when you're selecting those, not to deter you from doing one or the other, or to advise you to go into one of those. But I think the thing to keep in mind is that more risk, historically, there's been better returns over the long term with more fluctuation. So that's what you want to realize when you're selecting one of those. So these target date funds are more for people that just want to kind of set it, forget it. These get automatically more conservative the closer you get to retirement. If you're the kind of person that really wants to kind of create and build the portfolio, pick large cap, mid cap, international bonds, there are other options in there, and you can build those yourself. But again, for right now, we see most people in these. So again, feel free to put anything in the chat there if you have additional questions on that. I think, and then yeah, I think that's it on that, unless you have something to add there, Britton.
Yeah, I just think the takeaway is we got two types of risks here. Like how much risk you need to take to get to retirement. These target date funds are great they're age based to kind of get to that point, but everyone has a different risk tolerance, each one of you, and there's a balance between applying those two. And if you're doing it yourself, especially in the 401k, a lot of you are. I just keep in mind that they're not all designed the same as well, and pulling up the hood and working with a financial advisor may shed some light on like how much risk you're actually taking. I noticed a couple people joined us recently, so we are going through the financial calendar for January and February of 2024. It's just a couple nuggets that we pulled out to go over today, but stick around to the end. You will get the full calendar, a link in the chat to take home with you. And next section is going to be a Q&A. We've got some questions queued up from some of you from a prior survey. Thank you for those. And if you have any, please put them in the chat. We'll get to them. So now it doesn't want to go to the next slide. All right, so we're going to pause for questions. Like I said, every 10 minutes, we're going to be doing this. After this section and after February, we've got some to get to, so we're going to jump right into those. And Todd, I'm going to let you lead off.
Yeah, we did a lot of questions leading up to it, up to today. This first person, I'll just read off what he has to say. So he's confused about moving the 401k around to prepare for a downturn. He mentioned gold, money market. Wasn't sure how to do it, and also mentioned they make it kind of difficult. I assume you're referring to Empower. It is definitely acknowledge that they make it a little difficult to actually find how to change the investments. So you're not the only one. Just to give you real quick overview of where you go if you want to make changes. You're going to log into Empower. That link is in the chat. You'll go to account. Then you'll go to a drop-down investments. And it's going to be change my investments in a blue box on the bottom right. It's easy to look, even though it's blue, it's easy to kind of miss that. And then you'll click on that blue box and then you'll say, do it myself. And then you can change it around that way. So that's the mechanics of how you do it. Now, around being confused about potentially moving around and preparing for a downturn. So what we want to keep in mind, and this is really, really common, to try to anticipate what's going to happen in the market. So you really need to be thinking about allocating for the long term, not for recent volatility. So that's a mistake a lot of people make, and I always say you have to make two right decisions. One, when do you sort of get out and get into something, say, more conservative? You got to get that right, and then two, you have to decide when to get back in. And if you didn't get the first one right, typically people get the second one wrong. it's when to get back in, because there's that fear of the market being down, and it's never really a good time to get back in. So, so the idea is pick something, go back to those three personas: Larry long-term, Carol conservative, Maggie moderate, and think about which one fits you the best, and select that, and select it for good times and bad times, because 9 times out of 10, you're going to end up having a better return, smoother return, if you pick what's appropriate from the beginning and not try to zig and zag with the market. Anything to add to that, Britton?
Yeah, well, I did put in the chat, as we will be throughout, links to respective websites, slides that we're talking about, some powers on there, as well as just the sequence of how to make changes into the portfolio. I did type that in for you. I think that the only thing I'll add with as far as the question goes is that having the allocation already in line with to weather the storm or weather the downturn, because the long-term goal may be retirement. Unless it's very near, then you should already be in have a portion of your a smaller portion exposed to the stock market if that's the downturn that's forthcoming. And so inside of the 401k, you have stable funds available to you that would provide you that income, but at the same time, it's specific to each one of you, and when you need the money, what's your risk tolerance, how long does it, what's it for? I mean, it is for retirement, but I think it needs to be addressed before you know where to go. And so again, what we say today, we're going to keep it fairly high level. Can't give you any advice, but happy to talk with you one-on-one.
Yeah, and again, I've got a few more here that we had ahead of time, but anyone feel free to put put your questions in the chat here. So next person asked, is it better to have all your 401ks in one place? And he commented that I have one that is doing well. So it's a 7.75% year-over-year return, but it's an old 401k and I cannot put more money into it. Compared to my Wells Fargo 401k, which is doing worse, and I can put more money into that. Should I move my money? And this is another very common question, and sometimes a little bit of a misconception on what's actually happening under the hood. So what we find 9 times out of 10 is when we're comparing one 401k to another, an old one to a current, or vice versa, we really have to look at what the investments are that are in there. So is one heavier weighted in bonds than the other? And bonds are doing better or worse when we're making those comparisons. Is one heavier weighted towards small companies versus large companies, or international versus US? So you really have to look under the hood to see what is going on before you make that type of move. Because if they are in similar allocation, I'd be surprised if there's that big of a disparity in the returns. So I think this goes back to looking at where you want to be invested, what's your risk level, and setting those up across the board and in all of your accounts so that they're managed in the same manner. And when you consolidate them, it makes it a little bit easier to do that. So every situation is going to be different. We tend to encourage people to keep them consolidated, just it makes it easier to manage, easier to track. And again, some of that depends on the investments in there as well. So you have to just lift up the hood and look to see what it is. Again, we're happy to chat with you a little bit about that offline. For those of you that have multiple accounts, if you want us to take a quick look, we can kind of do an analysis to see what's going on and why it's doing what it's doing. I think that's the important thing, is to know why it is doing that. And that gives you more information. You can make a better decision at that point. So I'm going to move on to the next question. I don't think we have anything in the chat there.
I was just going to add a couple more people have joined us. Welcome. And we are going over questions. We're in between January and February next year. And to please, this is going to be a discussion. We've got questions to go over, put them in the chat. We're going over some of those. You are muted and your cameras are turned off, but by all means, you have the power to turn that on. If you would like to raise your hand and speak, you can do that as well. At the end, stick around. You will get the full calendar that we put together for you in the chat. There will be a link, so stick around for that. Go ahead, Todd.
Yeah, and feel free to drop any questions
Yeah.
in the chat as we're going through these, because we are allotting as much time as we can for the questions. So the next person asked, when do I need to take out money from my 401k? Can I roll this over into something else? What and when should I do this? So couple different dates to keep in mind, ages. So at age 73, many of you will have to start taking what's called a required minimum distribution, often referred to as the RMD. Now, that date has changed for those born, or that age has changed for those born in 1960 or later. So if you're born in 1960 or later, you're not going to be forced to take money out of an IRA or 401k account until age 75. So for many of you, have a number of years before you need to take money out. Typically, that amount does start at around 3 or 4% of the portfolio. So if it's $1 million in there, you're looking at 30,000 you're going to have to take out. And you're going to be taxed on that, assuming those are pre-tax contributions and not Roth. Second part of that question was, can you roll this into something else? Yes, you can. You can roll that over into what's called a self-directed IRA account, or just an IRA account. It's often referred to it. Often gives you more control, gives you more options outside of what's in the 401k plan. And again, some of it of when to do that may be specifically tailored to your individual situation, but at a high level, either age 73 or 75, you have to take that out.
Yeah, and you'll have to take that out of all your, if it's in 3 different accounts or more, each one has a calculation for them. You can consolidate them into one, but there are mechanics that you can't have it in separate accounts and avoid it. You do have to take it out of each IRA or 401k at those respective ages.
Okay. I don't think we have any more questions right now, but again, I encourage you to drop them in the chat.
Okay. We will move on to February. So in this month, what do you do with your bonus? You've received it and it's made up, it could be making up 40, 50% of your annual income for some of you. And with that windfall of money all at once, the question is, how do you spend it? Like, what do you want to buy? And having a plan is important. And I've got some examples over here to the right. You can invest it for yourself, for your retirement, for your kids. You can pay down the mortgage. You can pay down high interest credit cards, emergency reserves. I mean, it's important to take these vacations, but or you want to buy a car, a watch, all these things are options that you have. But how do you know that the money's really working for you? You're building your wealth, you're paying down your debt, and you're setting yourself up for success. Retirement is one big goal for a lot of you. And then you may also have kids in college, planning to go to college, getting out of college, but you're still funding that piece. And so that's a big balance that we work with clients. And one of the sayings is you can borrow for the college piece, and you have other sources of like grants and scholarships to use. You don't have none of that for retirement. So in other words, you don't want to sacrifice your retirement goal. But yeah, I think the theme here is like having a plan or a process to follow is important. And Todd, what else would you add to that?
Yeah, I think it's really a matter of working backwards. It's hard to answer these in a vacuum. When the bonus comes, it's real tempting to do a lot of these things. We get a common question we get is, should we pay down our mortgage or should we put it in the 401k? But you really have to work backwards. When do you need this money? When do you want to retire? Is it 60? Is it 65? And then work backwards from there. And you're going to have money that you based on those goals that you need to do certain things with 401k or 529 IRA accounts. And then the money left over, that's kind of more discretionary money. So again, until you know where you're going, you really can't make these decisions. So that's kind of the tricky part of this. Many people make these in a vacuum, just looking at today. But by having a plan in place, you're able to look backwards and backtrack. We'll make one comment about the mortgage. Typically in our plans, we like to have people have the mortgage paid off by the time they retire. It's usually the biggest obstacle to retiring. And there's usually a systematic way that we help clients do that. So if the key is to do something systematically so that all of a sudden, when you hit 2 years from retirement, you don't have to come up with $100,000 or $200,000 to pay it off. So it's a matter of working backwards and having that plan in place, and then these become easy decisions, and not just something kind of swirling around in your head. And there ends up being a lot of confusion around what to do, and when there's confusion, ends up people are stalled and they don't take action. They feel stuck.
Yeah, but it all comes back to what you really enjoy in life and taking that vacation, spending time with friends and family, especially because I know from working with a lot of Wells Fargo employees that you guys work so hard, work to death. I mean, you need to take time for yourself, and carve out, wherever you want to enjoy, like to go skiing or to the beach. This is the time that you can put some money aside for that. All right, well, let's jump into the next slide. How to contribute directly to your HSA. So a lot of you, if you have an HSA on your healthcare plan, you're going to be contributing throughout the year, maybe per pay period, $100 here, a few $100 there, and maybe you're using it throughout the year. And so in the next couple of slides, we're going to be talking about the HSA because it comes up a lot. We noticed that it's not taken advantage of fully, and it may be misinterpreted as well because it could be used as a long-term tool as well. But here, just want to show you how outside of what you're already contributing on your pay cycle to go ahead and contribute directly. And the way you go, there's a link in the chat that Todd just put in there. It's optimbank.com, and you can log in, you go to contributions, and you follow the prompts to transfer from a bank account below, click continue, and then you can make those contributions all at once. Now, one of the reasons I also bring it up is it's December, so you can catch up to max that out for this year by going through these steps. So again, we're talking about the health savings account. One of the big benefits is, or there's three main benefits on the tax side: tax deductible contributions going in, so lowers your taxable income. It can grow tax free. We're going to talk about in the next slide about how to invest it and how much you're allowed to. And then the third thing is, of course, that you're aware of it, you can pay for qualified medical expenses tax free. And as a planning tool for retirement, this is one of the few things that you have available to you to keep up with the Medicare, the higher costs in healthcare in general. Yeah, you may be going on Medicare at 65, but you won't have this available to contribute to at that point. But you can use these funds for expenditures in retirement. And what I've seen working with clients planning for early retirement, especially, is that the high cost of private health insurance, even with what Wells Fargo can quote unquote provide you to get to that point, it's going to be expensive. And this is a tool to use for those expenses. And I'm going to jump into the investing side of the HSA. Same website. Again, the link's in the chat of how to get to it, Optum Bank. And this is how to invest. You go to the investment, and let me just talk about this for a second. Why would you invest the HSA? As I just mentioned, it can grow tax-free. So above $2,000, you can invest. Of course, they want to keep it so you have some liquidity available for immediate medical expenses. So they kind of de-risk the portfolio in a way to only allow dollar amounts above $2,000. So this is how you go to investments and you just follow the prompts, HSA to investments, and you can choose your different investment vehicles. When you would need to move the money back is the next couple of prompts, but just I think today let's focus on how to get that money working for you, especially if you don't need it over the next 1 to 2 years.
Yeah, and I think the main thing here to take away is that I want to emphasize that there's no other vehicle where you can get this type of triple tax savings. So it goes in pre-tax, you don't pay taxes on it. Tax-free growth. Again, putting it in the investment account is going to allow it to grow tax-free. And then when you take it out, it's taken out tax-free without any taxes on it, assuming you use it for medical. So there's no other vehicle like this, and it's so overlooked. A lot of people put it in for the pre-tax, but then they immediately take it out for medical expenses in the current year. So that is one way to do it. We don't necessarily recommend only using it for that. You really want to get that triple tax advantage on these dollars. And again, on the previous slide, Britton talked about how to put it into the HSA.
Sorry.
Do you want to go back to that previous one? Yeah.
Sure.
Just to emphasize that again, a lot of folks will contribute $100 or $200 per paycheck, or they don't want to commit to the full amount to max it out just because of other cash flow concerns maybe. But at the bonus time, it's a great time to just make that one-time contribution. So you could do it monthly. You could do it as a one-time contribution at bonus time, just going directly to Optum, or you could do a combination. So they give you a lot of ways to put it to fund the HSA and to fund it fully. So just again, it's a big tax advantage, most common overlooked tax advantage I see out there.
And so we have a question on the chat, and I think it's referring to like the total amount and the amount that you can put into the HSA per year. Do you see that question?
Not sure if I see it, but you could, I think I put in there that for 2023, put in 77,750, and then for 2024, I'll drop it in there too. It's 8,300.
And so the question,
look at your, go ahead,
yeah,
Brent.
I think what they're asking is if your employer puts in some money, does that count towards the total amount, or is that an addition to the employee part?
It does count towards it, so you need to take that into consideration.
Great question. Okay, let's move on to RSRs. So restricted stock units, RSRs, RSUs, same thing. Restricted shares, very similar to what they also provide you. It's just single stock exposure, but I'll talk a little bit about two things. One, the risk associated to these, as well as the tax side. And so first, I think it's the same theory of like if you're some of you get these and some of you don't. But I think the takeaway here is identify with the risk of single stock exposure in your portfolio in general. And so if you're granted shares by Wells Fargo, that dollar amount vests, and when it vests, you do pay taxes on that amount. The dollar amount that you end up getting, view it as a decision to buy the stock. So if you were to buy the stock at that time, then by all means, that may be supportive of you keeping the shares in Wells Fargo. If you wouldn't, then that's going to be supportive of not keeping it. So the riskiness of this growing, I've got an example of a client who came to me in 2021 at the end of the year when the market was near all-time highs, and he was wanting to retire early into his early to mid 50s, and he had over $1 million in RSRs at that time, and the stock's at all-time highs, like $60 a share. He was emotionally attached to the stock. I said, look, Jim, we'll call him. You got to sell the stock because it's going to go down. I mean, the market's at all-time highs. And he rebalanced some of his ESOP portion, but he was waiting for a certain stock price, target price to hit to sell these shares. The reason why that he really needed to sell was because he needed to have the money available for income in retirement. If you're going to retire early, in other words, before 59 and a half, or definitely before 55, you're going to have limited availability to what you can use from your savings. So if you have taxable savings, which is where these RSRs are placed, then you can have access to that to generate income in retirement and pull money out. But if it's invested, you're going to see a lot of volatility in the near term that could be detrimental to your plan of pulling out retirement. So again, ultimately, the stock price dropped to, as you know, into the 30s, and it's come back a little bit. But my point is, we had to do a different plan for Jim. We did a Rule of 55, but not to get into that. He ended up paying more taxes than he had to. So again, the risk of having single stock exposure heading into retirement is real, and so there might be a case to sell it when it vests. Again, good thing to talk about this with a financial advisor. I'll hand it over to Todd. He's going to talk a little bit about the taxes on RSRs.
Yeah, I just mentioned I did drop a link to an article. We have a pretty detailed article, kind of all things Wells Fargo RSRs. So a lot of detail in there that we won't have time to get into. But if you do have RSRs, take a look at that. The RSRs, when they vest, they are taxed as ordinary income. So a lot of people either forget or don't realize that, and it bumps them into a higher tax bracket, and they end up at tax time with a big surprise. So just be aware, depending on the size of it, that could bump you up. Work with your accountant, or if you do your own taxes, just do some projections on that. And what Britton was sharing about the client who was close to retirement, what we like to say is that you want to reduce your risk when you're getting close to retirement, and in often cases that increases your probability of success. So when we talk about success, the success of retiring on time, or the success of not running out of money when you're in retirement. So any type of single stock risk, whether it's Wells Fargo or any other bank stock or any other stock out there, typically what we see is that single stock holding does not necessarily increase your returns over the long run, but it adds more volatility and it adds more risk, and oftentimes reduces your probability of success when you're retiring. So what we like to do is decrease risk and increase the probability of success. So just again, think long and hard about holding on to those single stock positions of Wells Fargo and how that may impact you on the downside potentially. So I think that's all I have on this.
Okay.
This one, Britton, if you want to move on to the next slide.
Absolutely. All right. So next one, we're going to pause for questions. I think we've got a couple more, Todd, right? As well. Oops, sorry. Let me go back to that slide. Yep, pause for questions. So please put them in the chat, raise your hand, and we'll get to you. We'd like to hear from you what's come up over the past few minutes when we've gone over these sections, or something that you had on your mind that we haven't gone over that you want to ask. We've got a lot more information outside of what we're covering today that's going to be in the calendar we provide you in a few minutes.
Yeah, so we got a lot of questions on taxes or tax strategies. So I'm gonna touch on those, and we'll probably lump them all together because they're pretty similar. Although this first question, I'll answer this one specifically because it is. Let me read that to you. But what are the tax implications of moving the value of an active 401k to an IRA or similar investment? So first thing is, some of you may be able to move money pre-59.5, depending on how long you've been at Wells Fargo. So you may be able to move that into an IRA or similar type of investment. And just to clarify, I'm not sure what this person meant by similar investment, but it would have to go to another 401k or IRA account to move that money. You have to stay pre-tax vehicle to pre-tax vehicle. If you do that, there will be no tax consequences if you process that rollover or that distribution properly, which we have seen mistakes happen. So just as long as it is processed correctly, there will be no tax consequences of moving the money from a 401k to an IRA. You could check if you are under 59.5, you can go to your Empower account. you could go to account, and this will tell you if you have any money available um, to roll over. So account, then you'll click on withdrawal, and that'll tell you what if you have money eligible to roll over or not. It's not going to apply for people that are kind of more recent employees of Wells Fargo. There were some historical plans that Wells Fargo had in place that now you're able to roll those out. But for most people that are under 59 and a half, you won't be able to roll it out until you reach 59 and a half. At that point, you pretty much have the option to roll out into another vehicle, namely an IRA account or Roth IRA if you have some Roth dollars in there as well.
Okay.
So that's, again, if that didn't answer your question, just kind of put more in the chat there. Let's see. So again, a couple, just again, questions around tax strategies for reducing taxes. I'm going to give kind of a high level overview on tax strategies. We are going to, in the March webinar, if you didn't catch in the beginning, we are going to be doing a deep dive into taxes. So we'll go into some of these strategies, probably in a little bit more detail. The biggest and easiest way to reduce taxes is to simply maximize the retirement plan. So the 401k, traditional IRA, or Roth IRA, depending on your tax bracket. So a couple decision points on whether to put money into a your pre-tax 401k or the Roth 401k, which is after tax but grows tax free and is eligibly taken out tax free. So if you think you'll be in if you're in a lower tax bracket, if you think you'll be in a lower tax bracket when you retire, then it may make sense to put pre-tax money in now. So will you be in a lower tax bracket when you retire? That's something to consider. There's also something called a backdoor Roth IRA. So if you make over $200,000 as a family filing joint, you will not be eligible to put money directly into a Roth, but there is a strategy called a backdoor Roth IRA. I won't get into details. You need to make sure that that's processed correctly. We also have a lot of questions around Roth conversions upon retirement, just factors to consider. So I'll give you a couple high-level factors to consider in terms of whether you should do a Roth conversion. Typically, we see these after somebody has retired and their income goes down. Usually does not work as well when you're working and have an income to do these conversions because you're taxed at your ordinary income bracket. So in looking at that, you want to compare your current bracket to your future bracket. You want to look at when do you plan to start Social Security? That's another factor that comes in to play. You also want to look at whether or not you're going to take a pension or a lump sum. Sometimes that plays into the decision of do a Roth conversion or not. If you plan to take a pension, it may not be as favorable because that's more income for you. You also want to look at the RMDs when those are coming out. We talked about those a little bit earlier. Will those push you into a higher tax bracket? We gave an example of if you have $1 million in IRA and 401k accounts, in your first couple of years of those required minimum distributions, that might be an extra $30,000 or $40,000 in ordinary income that'll push you into another bracket. And so if you start doing Roth conversions at that time, you may be unexpectedly paying more than you need to. So when those RMDs are going to start, take that into consideration. There's also something called the widow's penalty. So that's when the first spouse dies, the other spouse is usually pushed into a higher tax bracket. So if there's a big disparity in age between spouses or health issues where one spouse may die much earlier than the other, or you may want to consider doing a Roth conversion because that person is going to be taking RMDs out that could pump them into a much higher tax bracket unbeknownst to them, not because their income changed, but because the tax brackets went up because they were filing single as opposed to married. Couple other ones, we already talked about the health savings account. doing that, you have time to do that between now and year end. Donor advised fund is also overlooked, and I'll drop a few of these into the chat as well. But a donor advised fund is something to consider if you're charitably inclined, and if you contribute quite a bit to charitable causes, the donor advised fund may allow you to get a tax deduction if you do a lot of that up front into the fund, and then you could disperse it out over next 1, 3, 5, even 10 years. Coming up on year end, looking at harvesting capital losses, so taking losses when you can. The Medicare surcharge, this is one that's often overlooked. People just aren't aware of it. When you retire, you're going to be on Medicare at age 65. Your base premium is $175 per month per person. Oftentimes, if you have to pay that surcharge, it might be $350 a person, up to $450 a person. In particular, we see this kick in for a lot of people during the first year that they retire, because Medicare looks back to your previous year's income. And unless you appeal it, they will charge you that amount. So that's thousands of dollars in potential tax savings if you just know to appeal it. Again, we went through those kind of quickly, but those are just few tax strategies in a nutshell. We'll go over in more detail in March. Britton, anything to add to that?
No, again, it's when we talk about taxes, it gets into the weeds, and I think we could have a whole session on that for sure, and that's why we have one coming up in March. And if you have anything specific that's on your mind that you want to dig deeper into one of those beforehand, by all means, our contact is in the chat to schedule a time with us if you'd like. And as Todd mentioned, there's other resources that he's put on there as well, articles that we've written. And yeah, I think that's it. All right, is that all? Any other questions?
Yeah, I'm going to make sure, again, we are going to put our contact information in here, and then the Wells Fargo financial calendar, I'm going to drop that in there as well. Again, it's filled with, I think, over 40 different actionable items. So take a look at that. If you have questions, contact information is here. Make sure that you get in contact with us, and we can walk you through some of those. There were a few questions. I apologize, we couldn't answer them. There were a few that are very specific to some individuals, so we may have to take those offline.
Yeah.
But if you want to just kind of give final thoughts here,
Yeah,
Britt, we can wrap it up.
So we're in December. You got a little bit of time to make some changes. One of them is to make your final contributions to the 401k. You want to do that now because it may take a pay cycle or two to take effect. In other words, to max out the 401k at Wells Fargo on the Empower website. I went through it earlier of how to change it for the bonus, but this would be changing it for, taking advantage of maxing out for the amount that you're allowed to for this year. And remember, there's a catch-up amount that you can contribute to if you're over the age of 50. In addition to the 401k, maxing out the contributions to the HSA, talked about that earlier. Go to the Opt-in Bank website for 2023. And lastly, if you do get RSRs or they've vested this year, or maybe you have some other income capital gains that have been realized, and you're not sure how much money you're going to owe for taxes, coordinate with your CPA or tax advisor, financial advisor to identify, what is it that you may owe, an estimate that is on January 15th. You can pay that to avoid tax penalties when you file. In other words, you don't have to wait until you file in the spring, because you may owe penalties by delaying it.
Yeah, and then just one thing I'll add to that, we went over a lot of these tax strategies pretty quickly. I think Britton mentioned, but the coordination with your accountant, with your CPA, is really critical. Whether, whether you're doing your taxes yourself, you're working with somebody, make sure you're coordinating, and then coordinating with your financial advisor. Or if you don't have a financial advisor, make sure you're talking to the accountant before December 31st. I like to say a lot of CPAs they're simply historians. By the time they get your information, they're just entering it into the boxes, and there's not much that could be done. So that coordination ahead of time to look at some of these strategies, some less complex than others, to make sure you're doing that. Because when that tax bill comes, a lot of times it's a surprise, and if you haven't coordinated, you may not be prepared for that, or maybe you didn't do all the things you could have to reduce that tax bill before 12/31. So if you haven't done so, contact your CPA between now and year end. Feel free to contact us. We love talking about taxes. It's oftentimes an easy strategy to save people money, and makes a big difference year over year.
Yeah. And again, the link to the calendar for you is in the chat. Feel free to email us, call, text. Our contact information is on the website, and the links in the chat as well. Thanks everybody for coming. Happy holidays, happy New Year.